What's up, everybody? Today is Fed Day. It is the Federal Open Market Committee meeting. They are expected to cut rates by 25 basis points. We have all the news and information for you right here, right now on the Cashflow Academy YouTube, and let's jump into it. So, what are we expecting out of this? Well, let's jump over to the calendar, and this week is just loaded with economic data and central bank meetings. You can see the Bank of Canada came out this morning and they cut rates by 25 basis points. The Fed funds rate, you can see the countdown. We are 2 minutes and 30 seconds away. They're expected to cut rates by 25 basis points. You've got the Bank of Japan out tonight, and then you've got the ECB, the European Central Bank, out. Neither one of those central banks in Japan or Europe are expected to cut rates, but here in the US, we are. And when you start to cut rates, as you can see within the trend of rate hikes and rate cuts, we always say that these things trend very nicely. The Fed, once it starts cutting, it goes through a cycle of cuts. So it might pause in between meetings, but we are currently in a rate cutting cycle. See the rate cuts, and then they pause, and now we're cutting some more. Back here in 2022, they began a rate hiking cycle, and then it lasted, as you can see, for multiple quarters where the Fed was consistently raising rates. So how much more can they cut? Well, the Federal Reserve has two mandates, right? They want to keep full employment. We've seen the employment picture really weaken here in the US, not just the reported numbers, but they even revised down prior numbers by over 1 million jobs. So it's been a really bad situation for jobs. That's one of their mandates. The other mandate is price stability, which means they don't want inflation to get out of control. Now remember, the Fed royally screwed up inflation. They allowed inflation to ramp up a couple of years ago where it was around 10%, and that is just not price stability. So they don't want to have a double dip of inflation. They don't want to screw that up a second time. And that's what they've been waiting for. That's why they haven't been more aggressive with rate cuts. Right now, even with inflation around 3%, that's missing their target. Their target is 2% inflation. Even though they're missing that, they say, okay, the jobs number has trumped, the jobs risk has trumped the inflation risk. Now, I kind of look at that and go, well, I think job losses are something that's coming because it's AI induced. Look at the biggest tech companies. We've seen massive layoffs. We saw Salesforce lay off a huge amount of people even as their record earnings hit and they increased share buybacks. Just yesterday, there was announcements from Amazon and UPS. So there's all these huge corporations that are just laying off thousands, even tens of thousands of employees are being laid off. So let's see where the Fed funds rate comes in. And more importantly is usually the statement. So you'll notice that along with the Fed funds rate, if we look at what else is happening here, you also have the statement that comes out. And the statement is basically their insight into whether or not more rate cuts are coming, what the discussions are, how many people voted one way or the other within the Fed. And so having said that, it is always a little instructive to come into an intraday chart and see the market's initial reaction. We could even come into the 1-minute chart, and you can see that the knee-jerk reaction in the S&P 500 was a shot higher. Nothing too significant. Let's not make this more than what it is. I would say as far as Fed meetings go, this is kind of a dud in terms of volatility. But it shot up about 10-ish points in the S&P, just under 10 points. It's given back some of that, but it's kind of chopping around. A lot of times you'll see a much bigger reaction. This time, I think it was kind of laid out, and maybe the markets just are not that concerned. What often happens, and I've traded this in the past, so when you have a reaction, let's say that the Fed announcement comes out right here, and the market is at this price, and it jumps up. The immediate knee-jerk reaction is a big move up. Actually, traders will often fade that initial reaction. They'll fade the move because usually it's not a boom and then it just keeps expanding. So they'll look for an opportunity to fade the knee-jerk reaction. Well, you saw that in the price action today. Again, looking at this chart, what was the knee-jerk reaction? We started here on the announcement, and boom, it shot up, and they faded that, and you can see how quickly it deteriorated right back to basically where it came from. You may even see this continue to expand lower. We'll get a little bit more information here in the near term, but the knee-jerk reaction, well, look at it intensifying. Now you can see it starting to sell off, and we've broken below the Fed meeting area. So the Fed had two dissents. There were two Fed governors that favored no change in interest rates. There were a couple of dissenters within the Fed, it looks like, as the news is coming in. You can see the reaction and the market starting to weaken, starting to soften here. So if we come into the daily chart, doesn't look like much. We can zoom in there. It's a little tiny candle. Again, I'm not going to make this any more than it needs to be right now, but I would say that the market's in a little bit of a dicey predicament right here, right now. Would I rather be a buyer or a seller? A seller, absolutely, in the short term. Why? This candle right here is what we call a distribution candle. A distribution candle is basically a wide array of selling. Selling that is so intense that the vast majority, the high percentage of stocks within the S&P 500 all sold off that day. When you pay attention to market breadth, when you get distribution candles close together, it tells you that the big boys are starting to unload. Now, that's only one, but I suspect, it's my opinion, and I've been on record as saying this to our students, that I would anticipate another distribution candle is coming very soon, within the next couple of days. And so imagine that it comes today. Imagine that we, sell off, and I'll just keep drawing this out, some big red candles, some big distribution. Well, now you have a little bit more of a problem. You might say, well, Corey, what are you worried about? The market's at new highs, new all-time highs. Isn't this a time to be bullish? Well, we're stretched away from the moving averages. Do you buy when it's stretched? Yes, if the market breadth, if the vast majority of sectors and stocks are going up. If there is not market breadth, that is a warning sign, especially if you're starting to see distribution candles. Well, why am I concerned? If I go to FinViz, look at the amount of stocks above their 50-period moving average versus below. It's 50-50. The market's at new all-time highs, but we have half of the S&P 500 above their 50 and half of it below. And it's even worse in that more than 50% are below. So you have actually 52.5%. You have more stocks in the S&P 500 in a downtrend than you do in an uptrend, even as the market's making new all-time highs. That is a warning sign for the markets. Why are the markets performing well? It's because the biggest names, like the NVIDIAs of the world, have been stellar. And that's it. End of story. It's not because the economy's booming and most sectors are performing and everything's good. No, if we let's look at a 1-month performance. You'll see the brightest green is in the biggest boxes, right? The Googles, the NVIDIAs, the Apples. Look at all the green. But there's a lot of red elsewhere. This is not a booming stock market. This is a booming large cap tech stock market. And this market breadth has not filtered out to the other names, and that is a warning sign, my friend. So take it for what it's worth. This is not the time to just throw caution to the wind. What could change my mind? Well, it would have to change in a way that all of those underperforming sectors, not all of them, but a vast majority of them, would really have to pick up the baton. They would have to start to perform, and I'm just not seeing it. I own a good amount of Berkshire Hathaway. I've bought protective puts on my Berkshire Hathaway, and by the way, those protective puts have worked out wonderfully well. because, like so many other things, it just looks vulnerable. It has turned into a short-term downtrend. This is Warren Buffett's baby, right? This is Berkshire Hathaway. It's a great indicator of a lot of different sectors within the market. It's very economically sensitive, and it's just making new lows. That is a problem. My protective puts are going sharply higher in value, offsetting some of my stock decline in those Berkshire shares. But that's the stuff that I've been doing. I don't trust this market, and I suspect in the very near term, and I'm comfortable being on record, that I think you're going to see another big distribution candle. Maybe not today, maybe it'll be more tomorrow or the next day, but watch for that big distribution candle, and then just know that there very likely will be some follow through. I don't blame you if you don't act on that until you see. And I would say I would wait for that confirmation. Wait until you see the big distribution candle. Don't try to guess where it's going to happen. Instead, let's let it happen. Let's get that confirmation, and then we can get more pessimistic on the S&P 500 and on, the market as a whole. Until then, I'll keep hedging up the things that are not the big large cap tech names. Those have been the outperformers. We're letting those flowers grow, but the other things are not acting so well, a little bit more protective. Now, in closing on this video, let me emphasize that we're not out of the woods yet. In, roughly 20 minutes, there is the press conference, and that press conference can change things. I'll always remember the Fed meeting where Ben Bernanke came out. Well, for years he had said, look, we're using the benchmark as far as continuing to do quantitative easing, do money printing measures. We're going to do that until the unemployment rate breaks below 4%. And it finally did. It went down below 4%. And so everybody assumed that the Fed was going to follow through on their promise, wind down quantitative easing, and so on. And in one of these press conferences after the meeting, somebody asked him about it, and he said, you know what? We've been using that as our benchmark, but that's outdated. We're going to continue with money printing. We're going to continue with quantitative easing. We're going to continue with our bond buying programs, all of those sorts of things. And guess what? The markets rocketed higher. They shot up because the markets love easy money policy, right? The markets love it when the Fed is accommodative. It's like steroids for the market. So don't underestimate the press conference as something that could change the market's behavior a little bit further. Hope you're enjoying the Cashflow Academy YouTube page. Keep subscribing so that you can get content like this one and make you a smarter, more well-informed investor. Watch out for that distribution day, and we will see you in the next video. Check this one out.